Hello, everyone. Welcome to today's presentation on the taxation of intercorporate dividends in Canada. By way of reminder, before we actually get into the content of today's presentation, we just want to remind our audience that today's presentation is primarily targeted towards business owners and owner-managers, C-suite executives, management, and entrepreneurs, all of whom have business interests in Canada. If you happen to have at least 2 or more Canadian corporations in your corporate structure, then this presentation will have even greater relevance to you. While tax and accounting professionals are welcome to join us, it's important that you understand that this presentation is primarily targeted with the broader business community in mind. And as such, the level of depth that we go into may not be appropriate for domestic reorganization income tax specialists. And so with that background out of the way, we would like to introduce today's speakers next. So I'll begin by introducing myself, and then I'll turn it over to my colleague, Aman Sandhu. My name is Zach Bronstein. I'm a director of tax here in Andersen, Canada. I've been practicing in income tax for 15 years now. My practice is primarily targeted towards tax-based advisory for M&A transactions. I also provide tax planning and advisory services to owner-managers and private corporations and high net worth families on their domestic and reorganization tax planning. And my practice also includes trust and estate planning. I'm a chartered professional accountant and chartered accountant designated with CPA Ontario. I've been designated as such since 2014. I am also a trust and estate practitioner as well with STEP Canada, and I received my Bachelor of Commerce with the University of Toronto. And so now that I've provided you a bit of background for myself, I'll now pass it over to Aman to introduce himself to the audience.
Good morning, everyone. My name is Aman Sandhu. I am a senior tax manager here at Andersen LLP. I have over 15 years of Canadian domestic tax compliance and planning experience in a wide variety of industries such as retail, oil and gas, manufacturing, construction, professional tech, finance, you name it. More recently, I've been working on cross-border tax planning between Canada and the US, given our political climate down south. And my background is I am a CPA, CGA. I primarily have articled here in Calgary, born and raised. And I've also completed my in-depth tax, which is a 3-year program. And I went to SAIT and the University of Lethbridge. I appreciate the opportunity to be here to speak with you on complexities of intercorporate dividends. And I hope this will be a fruitful session. Thank you. Back to you, Jack.
Thanks, Aman. So now that we've introduced ourselves to our audience, just a little bit of housekeeping before we get into the actual technical subject matter of today's presentation. We want to begin with letting the audience know that Andersen is NASPA accredited. And so what that means is we have the capabilities of issuing CPE and CPD credits towards any professionals on today's call who needs to track CPE and CPD credits for purposes of maintaining your professional good standing. And so should that be something that you wish to receive, it's important that you answer all of today's polling questions. There will be 3 in total, and that you remain fully connected to this webinar for the duration of the presentation. There will also be an opportunity for you to ask questions and pose questions to Aman and myself. And so we've allotted a few minutes at the end of the hour to take a few questions and respond to those. We'll also have a post-presentation survey. We invite and encourage you to please complete that survey. It gives us really important feedback. We strive to deliver quality presentations, and we always strive to learn from our experiences and to do better. And so if there's things that you like that we did well, please let us know. But also if there's things that you think we can do better for next time, absolutely let us know that as well. And For those of you who would like a live transcript, there should be a closed caption button at bottom of today's web Zoom meeting that you should be able to click so that you can receive a live transcript as we go. And so to begin, we have an agenda here for you today in which we'll review a number of tax rules as it relates to intercorporate dividends in Canada. But we wanted to be upfront and transparent with you as to the objective of today's presentation, really a unifying objective that will be relevant throughout all the different topics that we speak to and introduce to you. And the objective is the following. We hope to identify and address and remedy what we feel is a widely held misconception. And that misconception is that dividends can be paid from one Canadian corporation to another Canadian corporation tax-free. Generally, it's not something you have to think about. It's not something you have to question. You can just unthinkingly, always, at all times, pay dividends from one Canadian corporation to another Canadian corporation. And there will never be tax consequences to that. And that misconception exists, and we hope to identify it as a misconception to you by speaking to all the different rules that say, hold on, not so fast, that's not the case. And to demonstrate to you that while dividends may be paid from one Canadian corporation to another corporation situationally, depending on each taxpayer's own situation, there's a difference between dividends being situationally tax-free as opposed to generally tax-free, because they're not generally tax-free. And our hope is to make that case to you as we go through this presentation. It's important that you understand that this misconception I'm speaking to developed over the course of time. It didn't just come out of thin air. And it came over the course of ongoing changes to the Canadian tax code as time's gone on. As new rules are come into effect and are introduced, it starts to shape the overall Canadian landscape and tax regime as it relates to intercorporate dividends. And that misconception has occurred more gradually historically, but it really took a sharp turn, probably most drastically in 2015. And that's when the Section 55 rules were brought in and expanded. And so we'll discuss those rules and introduce those to you. But we want to help explain the history of how that misconception came about. And in 2015 is really when the misconception became most significant and drastic, where the misconception really started to depart from what's the actual reality of the Canadian tax landscape. We also want to remind for our US audience that it's important to understand that there's no consolidated or disregarded or flow-through treatment in Canada. Each Canadian corporation is regarded as treated as its own separate taxpayer. And so that's why this issue isn't so easily brushed aside when paying intercorporate dividends in Canada, as might be under another tax regime that just allows for consolidated tax reporting. Aman, maybe I'll turn it over to you. Do you have any thoughts or comments as to what you've seen in your own practice and the other practices you've been with, as to kind of how this misconception can work its way into how advisors are even interacting with taxpayers and clients?
I agree. Generally, this misconception is fed because of lack of understanding of Section 82(1), how these dividends are classified and how they're taxed. So I have seen it in practice where people, maybe they read on the internet that generally it's tax-free, and this is something I've seen with a lot of articles online that is meant for the average taxpayer to read, and it always starts with generally tax-free. Intercorporate dividends are generally tax-free, but that I find is a misconception because it's very much based on the facts, and you have to examine the facts and determine that, which we'll get into more with some of the following slides.
Absolutely. Thanks, Aman. Turning the page now from our objective, we'll highlight the actual agenda for today in terms of the technical materials we'll be discussing with you. The first section of today's presentation is a presentation on an overview of intercorporate dividends in Canada. Section 2 is a discussion on Part 4 taxes. Section 3 is a discussion on Section 55 rules. Section 4 is a review of corporate structuring ideas and restructuring considerations as to how to respond to some of the tax rules and regimes that we'll be introducing to you. And the final section, the fifth section, will be a discussion on Part 6.1 and Part 4.1 taxes. So diving into Section 1, an overview of intercorporate dividends in Canada, it's important to identify some of the key legislation that gives rise to the general tax treatment in Canada that we mentioned as insofar as that misconception that we talked about. And so the beginning stages at which a dividend is included in income for all taxpayers happens under subsection 82 sub 1. And that subsection requires all taxpayers in Canada to include dividend income in their net income for tax purposes. So when I say all Canadian taxpayers, that would include individuals, trusts and estates, as well as corporations. And so that's sort of the blanket piece of tax legislation that brings all Canadian dividends into income for any Canadian taxpayer of all types. The 112 sub 1 deduction is uniquely available to corporate taxpayers to allow them to take a deduction for those dividends that they brought into income formerly under 82 sub 1. So whereas 82 sub 1 requires the income inclusion for net income for tax purposes, the 112 sub 1 allows a deduction from that amount to determine taxable income. And so the income inclusion under 82 sub 1 is offset by the deduction under 112 sub 1, so that when those two offset, there's no net income inclusion on the dividends received. And so this is a superficial understanding of these two subsections of the Income Tax Act relative to the full body of tax rules that can impact an intercorporate dividend, is kind of the beginnings of what has given rise to that misconception where, you can just pay dividends, they're tax-free, you don't have to think about it, you don't have to analyze, you don't have to question. And so that's where this is where that misconception takes its origins. Aman, any questions or rather any comments as to questions that you typically receive about how these two subsections can apply to different taxpayers?
Just generally, as you mentioned, but there's a couple of other things I'd like to add. We're oversimplifying due to the scope of our presentation here, but there are two additional deductions that are available, and that's for Section 113 and 138. Section 113 is a deduction when you receive a dividend from a foreign affiliate. So if you have a Canco, a Canadian company that owns a U.S. subsidiary, and that U.S. subsidiary pays a dividend upward to the Canadian company, that may be deductible as well. However, I need to caution that this section is complicated. This is something that we at Andersen are very well versed in, cross-border tax. And in order to pay out of foreign affiliate, you have to do something called surplus calculations, which is a very complicated area, but you would have to ensure that you have enough surplus to pay that dividend so that it is deductible for Canadian tax purposes. The last section was 138, which is dividend received from life insurance corporations. This is not very common in our practice and is quite rare. But the first two under 112.1 and 113.1 is a very common deduction and needs to be looked at.
Yeah, thank you, and that's a great clarification. These two subsections are what will apply most to domestic intercorporate dividends, one Canadian corporation paying another Canadian corporation. What Aman referenced as far as the 113 deduction has to do with foreign affiliates, so say subsidiaries of a Canadian corporation that are resident in other tax jurisdictions paying dividends to their Canadian parent corporation. And so that does give rise to further analysis and potentially surplus calculations, as Aman mentioned, and his practice and here us at Andersen, we're certainly able to help provide that analysis and support those calculations to help determine the taxation of dividends received from foreign affiliates as well. So with that introduction to as far as an overview on the taxation of intercorporate dividends in Canada, we'll now move to our first polling question. And so we'll give our audience 30 to 45 seconds roughly to be able to answer this question. And the question is, which taxpayers receive deductions for Canadian dividends received? So answer A would be trust and estates, answer B, corporations, answer C, individuals, and answer D, all of the above. So please take a moment to think about that question and provide your answer.
And I guess I can also comment on foreign dividends that are received from, let's say, the US. Usually, there's confusion I find from taxpayers on how that is to be included. But foreign dividends are usually taxed with Part 1 tax. There is no deduction, and there's no Part 4 tax levied on it, and it needs to be included on your Schedule 7, which will calculate your foreign tax credit. So there's a little bit of a differing treatment when you receive dividends from, let's say, Tesla or US-based stocks that you're unconnected to.
Thanks, Aman. I'm just waiting for the answers to populate. So 70% of our audience answered correctly and gave answer B, corporations. So congratulations to you. As far as all of the above, 25% answered all of the above. And while the deduction is not available to all of the above, the income inclusion under 82 sub 1 is applicable to all of the above. So while all of the above have to include it in their net income, the deduction is uniquely available to corporations to offer that offsetting deduction to that income inclusion. So thanks for your answers, everyone. And we'll now move towards a discussion on Part 4 tax, and I'll pass it over to Aman to lead us through that discussion.
Thanks, Zach. Part 4 tax. Many assume that dividends paid from Canadian corporations are always tax-free. However, Part Tax 4 can create unexpected liabilities, especially for passive holding corporations and corporate groups with complex structures. So what is Part 4 tax? Part 4 tax is a 38.33% refundable tax that applies when a corporation receives a dividend from an unconnected corporation, or if a dividend is received from a connected corporation, the tax is calculated based on the payer's dividend refund. So the next question is, how do we define what's a connect? How are you connected to a corporation? You're connected to a corporation if you are a recipient that owns greater than 10% of the shareholdings or value of the dividend payer, or if you, together with a non-arm's length party such as a spouse or children, control that dividend payer. So that's how you get into this section for Part 4 tax to be levied. And as I mentioned, Part 4 tax is a refundable tax. So how does it get refunded? Usually when you receive a dividend, and if you're unconnected, and as long as you meet the definition of the connected corp with no dividend refund being paid, you have to pay Part 4 tax. But you can also pay out a dividend to a shareholder that will help you refund that tax. So there is a mechanism to refund it. You have to pay out a dividend. Why does this matter? So holding companies and passive investment companies often trigger Part 4 tax because they have investments with portfolios with maybe under securities under RBC, CIBC, you name it. And when they receive portfolio dividends, they'll have to put that on Schedule 3 of their T2, and it will calculate Part 4 tax at the 38.33%. While this tax is refundable, the tax impacts your cash flow, and it also affects the timing of refund. So there are some planning considerations there. Risks to identify. Does your company own shares in another corporation but less than 10% shareholdings or value? Are dividends being distributed through a holding company? Are you relying on the refundable dividend tax on hand mechanism to recover Part 4 tax. So that's how when you pay out a dividend, it has to be paid to you get a dividend refund through the refundable dividend tax on hand. Any comments, Zach?
Yeah, I'm so glad you mentioned the cash flow comment, Aman, because that 38.3%, it's significant, right? That's more than a third. It's a significant percentage of the overall dividend received. And if if taxpayers are receiving dividends and not putting funds to the side that they're putting as a reserve for ultimately making installments and tax payments to CRA, they can be surprised when their tax bill ultimately gets computed when they file their tax returns. And so the cash flow, we never want that cash flow outflow to take people by surprise. And so this sometimes can, if you're not aware of these rules and properly accounting for them, and putting that 38.3% to the side. I also want to mention that the ultimate Part 4 tax obligation, as Aman spoke to, really depends on the connectedness, that connected status between the dividend payer and the dividend recipient. If the dividend payer is connected with the dividend recipient, yet the dividend payer did not receive a dividend refund on the payment of that dividend, then we know that Part 4 taxes would not apply, because the Part 4 tax, when there's a dividend between connected corporations, is paid based on that dividend recipient's pro rata share of what the dividend payer has received as a dividend refund. So if there's no dividend refund by the payer, then there's no Part 4 tax payable by the recipient. And as you would know, and sometimes this can require disclosures between payer and dividend recipient in order to allow for the payer to know whether they even have a Part 4 tax obligation or not, and to be able to share that information if the taxpayer is getting their tax returns done by, say, a separate accountant or advisor than the recipient, and vice versa. There needs to be information shared so that the tax calculations and tax treatment can be determined accordingly for the dividend recipient. Have you seen that, Amin, in your practice, where there is that information sharing going on with other accounting practices in order to determine the Part 4 tax liability?
Absolutely, I agree 100% with your point there. This I find can be missed if taxpayers aren't looking to get that information from the other accountant. It's very important to get their tax return. Usually, it's going to be listed in the T2, and you'll also be able to find that amount in the summary. But that needs to be included in the recipient corporation's Schedule 3. We need to input the dividend refund there, and then it will automatically calculate that.
That's great. So with that discussion on Part 4 tax out of the way, I think we're starting to build the case now to our audience that more tax rules need to be considered than just the offsetting deduction that corporations get under subsection 112. And so with that, we'll now turn to the third agenda item for today, which is a review of the Section 55 rules. And so the Section 55 rules apply in order to recharacterize what would otherwise be tax-free dividends, as we looked at under our overview, and to recharacterize that instead as taxable capital gains. And so those rules, as I mentioned earlier, were revised in 2015 in order to catch alleged abuses and surplus stripping that was taking place in a small minority of cases. And the rules were broadened to introduce what is a very broadly worded purpose test. And the purpose test is so broad that advisors who have really reviewed these rules carefully are effectively in agreement that the rules are so broad that they can apply to most intercorporate dividends. The reason for that is because one of the purpose tests states that where the purpose of the dividend is to reduce the fair market value of the dividend payer, Section 55(2) can otherwise apply absent an exception, which we'll review next. And so the really broad and far-sweeping purpose test has created a huge net that can catch otherwise innocent dividends within a corporate structure. And so those rules came into effect in 2015 and really broadened the reach of 55.2 to apply to most intercorporate dividends, absent an exception being available, which we'll look at next. And so if a dividend is recharacterized as a taxable capital gain, what happens to it is just what it says in its name. It becomes taxable as a capital gain and subject to then the taxable capital gains regime, which has also undergone some changes just last federal budget as well to increase the inclusion rate for most corporate taxpayers. So what was otherwise a significant tax outlay under Section 55 has now further increased with the increase to the inclusion rate under the capital gains regime as well. So some of the exceptions. So we discussed how Section 55 is so broad that it will apply to most intercorporate dividends absent availing oneself of an exception. And so for most taxpayers paying an intercorporate dividend, it's going to be very important if they're hoping for that dividend to be done on a tax-free basis. It's going to be very important to be able to make use of at least one of the exemptions under Section 55. The most common that we see in practice is a reliance on safe income on hand. And so safe income on hand is a tax attribute that is calculated annually and cumulatively that can conceptually be understood as a tax-adjusted retained earnings. It's really important to understand that the CRA requires up-to-date calculations in order for taxpayers to make use of this exemption. So in other words, it's not okay to just assume there's safe income on hand and pay that intercorporate dividend. CRA requires that calculations be done currently and on an ongoing basis, annually and cumulatively, to actually calculate what that safe income on hand balance is in order to make use of that exemption. There's also a Part 4 tax exemption, and so that circles back to the Part 4 tax regime that Aman mentioned. And that exemption goes on to say that if an intercorporate dividend was paid and it was subject to Part 4 tax, so Part 4 tax of 38.3% was payable on that dividend, and it was not further refunded as part of a series in the transaction, then 55.2 will not apply. And conceptually, that should make sense because if the government's already taxed it once in the form of that 38.3% tax rate, they're not going to tax it a second time in the form of a taxable capital gain. And so at least that makes sense in terms of the tax regimes working side by side. There's also exemptions available on certain forms of share redemptions. The most common that we'd see is when shares redeemed have a high cost base. So for example, if shares were acquired for a purchase price of $1 million and they're redeemed for $1 million, Section 55 takes redemptions and recharacterizes the amounts received on a redemption as proceeds of disposition. So if $1 million is received on a redemption, Section 55 treats that as proceeds on disposition. Well, if those shares redeemed also have a cost base, that cost base is then subtracted from those proceeds to determine the actual taxable capital gain. So effectively, when shares are redeemed for a fair market value equal to their cost, there's no net taxable capital gain because the proceeds under Section 55 equals the cost. Finally, there's certain exemptions available on corporate reorganizations. A discussion and analysis of those exemptions are outside the scope of today's presentations. They can be extremely technical and extremely complicated. However, we want to speak to them and just introduce them to you very broadly by name so that you are aware about them and know to speak about them with your respective advisors, or you can certainly connect with Aman and myself on these matters should you require an analysis of your specific situation. And so the first form of corporate reorganization that acts as exemption to Section 55 is on redemptions within closely held corporate groups. Those require no non-arm's length person to either increase their interest in any corporation under that reorganization. And so it's uniquely for closely held related groups. Think family-owned businesses. And then the second form of corporate reorganization are for qualifying spin-off butterflies. So once again, that form of corporate reorganization is outside the scope of today's presentation, but we want to advise you that they exist. Further analysis can be done to potentially plan into those exemptions. But again, those are only dividends that arise under those corporate reorganizations. So if a dividend arises outside of a butterfly transaction, then you can't rely on the butterfly exemption. If a dividend arises outside the closely held exemption, then you can't rely on the closely held exemption. So the actual exemptions themselves may be more limited than what is practical to most intercorporate dividends. And any further comments on some of what we've discussed so far as it relates to Section 55?
The only thing I can stress again is that Section 55 is considered very complicated. If you look at the books for this section alone, it's almost half the size of the Income Tax Act. So there's a lot of diligence involved in this part of the act, and it's very technical in nature. But that's something Andersen definitely can help with if you ever
Absolutely.
experience any issues with that.
Yeah. Thanks, Aman. And you're right. There's a lot of commentary and thought leadership and technical training that goes into helping reorganization specialists keep up with these rules and comply with them. Because when reorganization corporations, if you're spinning off divisions or spinning out assets, sometimes the valuations can be very significant. And if there's ever a deemed dividend that arises in the course of that reorganization, certainly taxpayers will be keenly interested to know whether those dividends will be taxable or tax deferred. The idea is our reorganization that we have in mind going to have a significant tax cost to it, or will it happen on a tax deferred basis? And so, for purposes of managing cash flow and expenses and outlays, tax is oftentimes the greatest expense. And so if there is, and there often is, motivation for a reorganization to take place on a tax deferred basis, fitting within those Section 55 rules will be of paramount importance. And so certainly in Andersen, we help our clients to affect their reorganizations compliant with Section 55 when and where able to do so. So what we want to do next is kind of take sort of a midterm recap so far of some of the tax rules we've spoken to this point in the presentation, and review some common corporate structures that we see in our practice, and look at how the rules we've looked at so far could potentially apply to some of these common structures. So the first structure on the far left is one where you have a single shareholder. He holds 100% interest in Holdco, and Holdco is a Canadian corporation. And Holdco, in turn, has a subsidiary called OpCo, and it owns 100% of the shares of OpCo. When seeking to move funds up the corporate structure from OpCo to Holdco, what commonly happens is OpCo will pay an intercorporate dividend to Holdco. And so what we've talked about so far is where there's an intercorporate dividend, we've discussed how Part 4 tax needs to be considered, and we've also discussed how the Section 55 rules are so broad that they could potentially apply to that dividend as well. So what is otherwise seemingly an innocent structure can actually give rise to taxable intercorporate dividends between OpCo and Holdco. The middle structure expands the structure somewhat, where we're now introducing two business partners, and they hold a 50-50% interest in Holdco. And Holdco, in turn, owns 100% of its Canadian subsidiary, OpCo. And so if it's desirable to move funds once again up the corporate structure, upstream, perhaps compensate its two partners by way of dividends from Holdco to its shareholders, well, what would be commonly typical is for OpCo to pay a dividend upstream to Holdco, and then Holdco in turn can pay dividends to the two business partners and compensate them for their investments in Holdco. But once again, the movement of funds from OpCo to Holdco would be oftentimes by way of an intercorporate dividend. And so once again, Part 4 tax and Section 55 needs to be analyzed and considered in this situation to actually determine whether that dividend between OpCo or Holdco will actually have a significant tax liability attached to it. The third structure is a bit different. That's more of an inbound structure. So that supposes a US parent holding a Canadian corporation, and that Canadian corporation owns 100% of the Canadian OpCo. And so if the foreign parent, the US resident parent, ultimately wants to repatriate funds upstream from OpCo to Holdco and then from Holdco to parent, what would be typical would be for OpCo to pay an intercorporate dividend to Holdco, and then Holdco pays the dividend to the parent. And once again, that movement up the corporate structure gives rise to an intercorporate dividend between OpCo and Holdco and can attract a significant tax liability unbeknownst to the non-resident parent. And it may be unbeknownst to the non-resident parent because they simply weren't advised that intercorporate dividends in Canada may be taxable. Maybe they operated under that same misconception that we've been trying to speak to and identify and remedy over the course of delivering this presentation. So these are three structures, all of which can be quite different in terms of their objective and purpose and their business operations, but all of which can carry intercorporate dividends and also can potentially have a tax liability attached to those dividends. And any comments or observations so far on what we've talked about as far as how intercorporate dividends can work in all different types of structures and give rise to an unexpected tax liability?
Not much for me to comment, but all these three structures I think are very common in our practice, especially the third one here with the US company inbounding into Canada. And there's other additional complexities that are added due to international tax there. But these are very common, I find. It can be even more complicated with many more shareholders. But yes, I think this is a great example of the type of structures that you'll encounter.
Thanks, Aman. So with that, I'll now bring up our second polling question, and it has to do with the structures we've just introduced to you. Which of the structures, polling question 2 asks, which of these structures can have taxable intercorporate dividends? And so the available answers are structure A, structure B, structure C, or all of the above. And so we'll give you a 30-second pause to think through what we've discussed so far and try and answer the question correctly. So Aman, you, just while the audience is providing their answers and we're collecting their answers, you had mentioned that you see all these structures within your practice. Would you say that your practice leans more towards one particular structure over the other, or are they spread pretty evenly across the three?
I would say for the Canadian side, it's A and B mostly. And then for, of course, the US-based parent or cross-border tax, C is very common, especially when a US-based company is looking to do business in Canada. But of course, that structure C is a little bit more complex due to the international tax angle. But nonetheless, as you mentioned, 55(2) can apply to a variety of these structures, and it can be complicated by the facts and how the dividends are being forwarded.
Thanks, Aman. And even a US inbound corporation might assume or presume, again, once again, consolidated tax treatment because that's maybe what they're familiar with in the US. They might try and structure their Canadian entities to be ULCs in order to consolidate those results into their US reporting. But once again, that's where the Canadian tax regime differs, and you don't get consolidated tax treatment in US. Each Canadian entity has to file as its own taxpayer, and that's what can give rise to the intercorporate dividends being taxable in those situations. And so the answers are in, the poll results are in. The majority of the audience has answered correctly. 88% has identified all of the above, which is correct. So I think we're doing pretty good at dispelling that misconception. All right, so next we'll dive into the fourth agenda item for today, which is a discussion on corporate structuring and restructuring considerations. So with that, I'll pass it over to you, Aman, to lead us through that discussion.
Thanks, Zach. So yes, corporate structuring and restructuring considerations. So how you structure your company impacts taxation, cash flow, and business flexibility. Understanding alternatives to dividend payments can help reduce tax liabilities and enhance corporate efficiency. So the first item we're looking at here is share redemptions over dividends. Share redemptions is when a corporation simply buys back the shares from its shareholders, whereas dividends is the after-tax profit payment of a dividend to its shareholders. As Zach had mentioned in some previous slides there, 55.2 has some exemptions in there, whether it's for share redemption or reorganization. So you want to look at, whenever you're doing share redemption versus dividend, you want to make sure to look at the 55.2 exemptions, because if there's an exemption available, perhaps it makes more sense for us to do a share redemption to avoid the risk of a dividend being recharacterized as a capital gain. So just to re-highlight some of the exemptions he mentioned was the high cost base exemption for the share redemptions, closely held exemption, and qualifying butterfly exemption when you do a reorganization and there are share redemptions. So instead of paying a dividend, companies can redeem shares, which may trigger a different tax treatment. So this is the reason this point is here, is to consider that. And share redemptions can be structured in a way to minimize Part 4 tax as well. The next item I have here is business combinations, amalgamations, and windups. These are usually completed on a tax-deferred basis and is very common in our practice, depending on the life cycle of a business. Whether you're starting up, whether you're acquiring a competitor and want to combine their service line with your own, or you're looking to make your structure more efficient, or you're at the end of the life cycle of the business and we're looking to dissolve. So merging companies or winding up subsidiaries can eliminate unnecessary intercorporate dividend payments, and this can simplify our corporate structure and reduces our tax risks under Section 55. So we don't need to do that analysis if there is no intercorporate dividend going up. So maybe it makes sense for us to combine a couple of corporations together, or maybe we need to wind up a subsidiary into the parent. And the last item I have here is intercompany loans over intercorporate dividends. So instead of paying dividends, maybe we should consider structuring funds as intercompany loans, which may provide a more tax-efficient treatment. In the Act, when you have intercompany loan from corporation to corporation, 15.2 does not apply, where it does for an individual. So you only have 2-year window in order to repay that loan. Otherwise, that amount can be deemed as a dividend. However, it's still important to structure the loan in a proper way that looks at reasonability for interest and for proper business documentation. Loan repayments generally do not trigger Part 4 tax, but must be structured correctly, as I mentioned. So some risks to identify for your business. Are dividends being paid instead of exploring alternative tax-efficient distributions, for example, share redemption, or maybe a shareholder loan or intercompany loan, sorry? Are there any redundant corporate entities in the structure that could potentially be merged or wound up to reduce administrative and tax burdens and remove risks related to intercorporate dividends? Could your company optimize cash flow by structuring distributions differently? So these are some questions to ask yourself. And if you feel that you're in those buckets, perhaps it's it's not a bad idea to have a discussion with a professional in this respect, and Andersen LLP is more than happy to help in that, especially since corporate structuring and restructuring is considered quite complicated, and it is fairly risky if not done in a proper way. Zach, any comments on this?
Yeah, so just on the topic of amalgamations and windups, you're right, Aman, that that could potentially be one resolution in order to reduce unnecessary intercorporate dividends. However, it's important to understand that there may be non-tax reasons that account for why more than one entity was set up in the first place. For example, asset protection or creditor proofing may have been one of the motivations behind keeping operations separate between entities so that one entity wasn't exposed to the creditors or exposures of the other operation and vice versa. And so there may be other non-tax reasons that explain why those two structures were originally organized as such. Also, when amalgamating two entities, another thing that maybe needs to be considered is when one of the companies being amalgamated with another company has already entered into contracts and agreements with other parties and vendors and buyers and purchasers and accounts payable and receivables and suppliers, because all those contracts may have to be amended or revised or redone in order to have the new amalgamated entity enter into those agreements because the predecessor entity no longer exists. It's been amalgamated into the new Amalco. So there's other non-tax reasons that may potentially act as a hindrance to those business combinations. And so we obviously, while we want our structures to be tax efficient, we never want the tax planning to lead the actual business activity or transactions being entered into. Tax should support the decision making, but we never want the tax tail to wag the dog. And so moving on to our final section, we're going to speak quickly to part 6.1 and 4.1 taxes. This is a tax regime that often gets overlooked, but again, the tax consequences to it can be significant. So part 6.1 is a tax on dividend payers. So if a certain dividend payment is done that falls under the part 6.1 tax, then an additional tax can be levied on that dividend payer. The question comes down to what is the share attribute upon which that dividend was paid. So part 6.1 is actually uniquely interested in what type of share is issued and outstanding that the dividend is being paid on. If the dividend so happens to be paid on something called a taxable preferred share, which is a defined term, and we'll look at that, or something called a short-term preferred share, then part 6.1 tax can arise. Part 4.1 tax is something of a reciprocal tax, and that taxes the dividend recipients in respect of dividends received on taxable preferred shares. Therefore, in order to ascertain whether part 6.1 or 4.1 taxes are a potential consideration under a structure, it's important to determine what type of shares are issued and outstanding in that structure, and do any of those shares meet those definitions of a taxable preferred share or a short-term preferred share. In general, a taxable preferred share is a share that offers a dividend entitlement to its holder that is either fixed or limited to a maximum or established to be not less than a minimum. Moreover, if there's a liquidation entitlement that is fixed or limited to a maximum or established to be not less than a minimum, then that form of share too would be a taxable preferred share. And finally, where a share is convertible or exchangeable into another class of share that would be a taxable preferred share, then that original share that is convertible or exchangeable would also so too be a taxable preferred share. What's important to understand is that the these definitions can actually apply not only to almost all preferred shares or special shares, but they can even apply to certain common shares that offer certain preferential treatment to their holders. For example, there might be common shares outstanding that do offer a fixed rate of return. Well, under those situations, that common share would be a taxable preferred share. And where there's a taxable preferred share, that's where Part 6.1 and 4.1 taxes can come into play. The definition for short-term preferred shares relates back to its name, short-term. That's where the issuer is required to redeem, acquire, or cancel the share within 5 years after issue, or the issuer is required to reduce the paid-up capital of the share within 5 years after issue, or the issuer is required to exchange the shares for another class of share that is a short-term preferred share within 5 years after issue. So all of these have to do with the share somehow coming out of existence or being converted or exchanged or redeemed or canceled within 5 years or less from the date of its issue. So suppose a dividend is paid on a short-term preferred share. What are the tax consequences? Well, for starters, there's a 40% non-refundable tax levied to the dividend payer under Part 6.1, which once again is a significant amount of tax. However, the payer gets a deduction equal to 3.5 times the taxes paid. So if the payer is a taxable entity and can make use of that deduction, the tax benefit to that deduction might offset most of the tax outflow attributable to the Part 6.1 taxes, but it may not shelter all of it. And so some analysis and computations might be appropriate there to determine the ultimate tax liability attributable to that dividend paid on the short-term preferred share. We'll also discuss some of the exemptions to Part 6.1 in a few slides. Next, we'll look at what are the tax consequences if a dividend is paid on a taxable preferred share. Well, the tax rate is a bit lower than the 40% that applies under a short-term preferred share, but not by a considerable amount. So for starters, there's a 25% non-refundable tax levied to the dividend payer under Part 6.1. And so that is lower than the original 40% that we looked at under the short-term preferred share. However, there's also a 10% non-refundable tax levied to the dividend recipient under Part 4.1. So between the 25% levied to the payer and the 10% levied to the recipient, they combine to 35%, which is much closer to the 40% that we looked at under the short-term preferred shares. It is important to note that dividends received by private corporations benefit from a 0% rate. So that means that the Part 4.1 tax won't apply to a dividend recipient that's a private corporation. However, the 25% can still apply to the dividend payer. So there may still be taxes payable by the corporate group, even where dividends are received by a private corporation on a taxable preferred share. There is an option to elect in the corporate group where suppose it's not desirable for purposes of obtaining funding, or if a dividend payer doesn't wish to burden its dividend recipients with complying with the Part 4.1 tax regime, there's an option to elect so that the dividend payer can pay at the higher 40% tax rate in the exact same manner as the short-term preferred share rules that we looked at under the previous slide. And this election would allow the dividend recipient to automatically benefit from the 0% rate. So an election like this could be desirable where some dividend recipients so happen to not be private corporations that they wouldn't automatically benefit from the 0% rate based on their organization. So just a discussion of some of the exemptions that exist to the Part 6.1 and 4.1 tax regimes. The first and most common that we commonly see in practice is the substantial interest exception. So if a dividend payer and a dividend recipient are related, then Part 4.1 and 6.1 taxes won't apply to that intercorporate dividend, even if that dividend is paid on a short-term preferred share or a taxable preferred share like what we've looked at so far. There's also an exception where the dividend recipient holds 25% of the votes in value. However, that 25% votes in value needs to be across each share class. So there can be cases where a dividend recipient, say, is not related to a dividend payer. Perhaps their shares do provide them 25% of the votes in value in aggregate. But if there's another share class that isn't a taxable preferred share, suppose there's ordinary common shares, and the dividend recipient doesn't hold any of that other share class, then despite having 25% of the votes in value, it cannot make use of that votes in value exemption. So that 25% votes in value can sometimes be harder to fit into and have apply than many taxpayers and their advisors might be aware. Another common exemption is for smaller sized organizations where the dividend payments are under 500,000 annually, because that's an exemption where so long as the dividends paid are less than 500,000, Part 4.1 and 6.1 taxes won't apply, even when those dividends so happen to be on short-term preferred shares and taxable preferred shares. And lastly, there is some planning available within the context of share redemptions. And so that can be another form of planning as well to try and move funds from one dividend payer to a recipient without having to give rise to dividends on short-term preferred shares or taxable preferred shares. So that leads us to our final and third polling question, which is what types of shares can give rise to Part 6.1 taxes? And so option A is preferred shares, option B is special shares, option C is some types of common shares, and there's A and B, or all of the above. And so while the audience is answering that, Aman, any comments just in general on your thoughts with the Part 4.1 and 6.1 tax regime, and if this is something that you find often gets overlooked by taxpayers or their advisors?
Absolutely. I think this is something that's overlooked quite often. I think it's just not very common in a lot of accounting practices to see these type of preferred shares or taxable preferred shares or short-term preferred shares. So I think a lot of accountants are just not aware of the Part 4.1 and Part 6.1 taxes and how the mechanics work in that section and how to even what schedules they even impact, I think. But yes, I think it's very much overlooked, and there's a lot of value here to be given, at least to address the risk associated with that.
That's right. And one of the reasons it might be overlooked as well is because the taxes are levied or determined based on the attributes of the shares on which they're paid, time, effort, analysis needs to go into actually reviewing those share classes, right? Reviewing the articles of incorporation, reviewing the share agreements to see what rights and privileges are attached to these shares, and are the rights and privileges such that this share might fall into a taxable preferred share or might fall into a short-term preferred share. And hopefully we've made the case that the taxable preferred shares are broad enough that they'll apply to more shares than most people expect at the very least. And so the results for polling question 3 are somewhat mixed. The most popular answer is the correct answer, which is all of the above. And so for 44% of the audience correctly answered that. The second most popular answer was answers A and B, which is correct. So certainly preferred shares and special shares can give rise to Part 6.1 taxes. But remember once again that some types of common shares can also give rise to Part 6.1 taxes because common shares, depending on the rights and privileges attached to them, can also be considered taxable preferred shares based on the definition of taxable preferred shares. And that definition centers on whether there's a fixed dividend amount attached to them or whether there's a minimum or maximum liquidation or dividend amount attached to them. So some forms of common shares, depending on the rights and attributes to those common shares, can also be taxable preferred shares, which means that they can also give rise to Part 6.1 taxes. And so we're at the top of the hour, so we'll just do a quick recap. So we've reviewed with the audience so far an overview of intercorporate dividends in Canada. We've discussed the Part 4 tax regime and how that applies to both connected and unconnected corporations. We discussed the very broad Section 55 rules that can act to recharacterize an otherwise tax-free intercorporate dividend and recharacterize it to become a taxable capital gain. We reviewed some corporate structuring and restructuring considerations and ideas on how to move funds within a corporate structure and perhaps not give rise to these taxable intercorporate dividends. And lastly, we've looked at the often overlooked, but potentially quite significant Part 6.1 and 4.1 tax regime. So I trust, having reviewed all these sections, that we've fully exhausted and dispelled that misconception that, oh, you can just pay taxes from one Canadian corporation to another. It's deferred, it's tax-free, no problem. What do you think, Aman?
No, I 100% agree. I hope this session helped demystify that. I know this topic can be quite confusing in that sense, and it's very common that a lot of people interpret that intercorporate dividends are tax-free when we've highlighted almost 4 or 5 sections that don't allow that. So always a caution.
Exactly. Thanks, Aman. And so we're at the top of the hour, but we'll take a question or two. And once again, we want to remind you that you'll receive a post presentation, post webinar survey. Please take a moment to respond to that. It helps us inform how we can improve. It gives us important feedback. It encourages us as to the things you liked, and also gives us feedback to the things we can improve on. And you can also help inform topics that you'd like us to cover in the future. And so we encourage and ask you to please complete that. And so we're ready to take a question or two, and just whenever, if any audience has any for us.
Hi, Zach and Aman. We've got a question from our audience. I'm posting it to you. Are non-resident tax withholding required when dividends are paid from Canco to parent, US parent? And secondly, is Part 4 tax not refundable because of non-resident shareholders?
Yeah, so Aman, do you want to take the lead, and then I can provide
Absolutely.
any color commentating there?
Well, it's a little bit of a loaded question. Well, let's just tackle it. Usually, if you're paying out a dividend from repatriating dividends from Canada to the US, you do have to look at the tax treaty to ensure there's no withholding taxes. There usually is a withholding taxes on dividends, royalties, or interest payments. But we would have to look at the facts and the articles in the tax treaty. So that is definitely a real tax risk there when repatriating cash from Canada to the US. And in regards to Part 4 tax, if it wouldn't apply going from Canada to the US because the US tax regime is completely different. But if you're talking just foreign source dividends were paid to a Canadian company and you're not connected or a foreign affiliate, then usually there's no Part 4 tax, but it will levy Part 1 tax. And there will also be a foreign tax credit that you have to look into.
Thanks, Aman. And I'd also add, once again, Section 55 rules need to be considered if there's an intercorporate dividend. You know, as mentioned, we looked at a structure where you have an inbound non-resident parent owning a Canadian holdco, and that Canadian holdco owns a Canadian opco. Well, the movement of funds from opco to holdco by way of dividend can be a dividend that could fall into that broad purpose test of Section 55. And so those are just some of the ways in which dividends can be taxable in that corporate structure. But again, the presentation and the advice given here is general in nature and in no way applies to any clients or prospects a specific situation. And so certainly if you would like your specific situation analyzed, we would absolutely invite you and encourage you to reach out to us, and we're happy to help advise as it relates to your specific situation.
Thanks. Another very broad question is, are there pros and cons of intercompany dividends versus intercompany loans? And again, it might be out of the scope of our presentation, but with regards to whether intercompany loan assets would disqualify it from the lifetime capital gains exemption rules.
Yeah, so I can take that. I think absolutely yes. Intercompany loans might be kind of putting, a Band-Aid on a wound, or it might be, considered a short-term solution with longer-term consequences down the road. So, the questioner asks, oh, could it impact, QSBC status for purposes of lifetime capital gain exemption? Absolutely. And even in my practice, in an M&A tax-based practice, if there's a purchase and sale in a target entity, and that entity has an intercompany receivable or payable, well, if the payable or receivable is with another entity that's not being sold as part of the purchase and sale, it needs to be resolved or dealt with in some way in order to complete the sale of the entity that is being sold. And so that might be by way of a future dividend in order to clear an intercompany receivable, so that you're just sort of deferring the taxation of that intercompany dividend to a later date. So absolutely, it could come back to bite you in the future. And so we are a few minutes past, and so I think we'll cut off our Q&A. And so we want to thank you once again for attending, and we'll invite you to just read this disclaimer before exiting. Just a reminder that the content and discussion of today's presentation is general in nature and in no way should be taken as specific advice to anyone's specific circumstances. And so thanks again for attending. Farewell, and we look forward to the next time. Bye-bye.
Thank you, everyone. Please don't forget to fill out the survey for us. Very valuable.